Good evening. Hello, everyone. I hope you're doing well. It was a crazy week in the markets, lots happening. Probably less charting focus this time. Let's just cover some of the main news. So, the Federal Reserve cut interest rates again, but indicated that inflation is remaining elevated. And as you know, I'm of the opinion that inflation has probably bottomed and that we're going to see a much bigger, more dangerous wave of inflation coming. And we'll have a look at some of the data on that. But firstly, Chairman of the Federal Reserve, Jerome Powell, says he is optimistic about a, quote, very good US economy. And he said, I feel very good about where the economy is. Honestly, I'm very optimistic about the economy and we're in a really good place. So if that's the case, why is he cutting interest rates, especially when he's admitting that inflation remains elevated? And we'll have a look at some charts in a moment, or graphs in a moment, that inflation it seems to have bottomed and has picked up, and it never even came down to the maximum allowable 2% target that the Federal Reserve has. Now, if the economy is doing so great, I'm not sure how many of you are familiar with a yield curve inversion. I've covered it in previous videos, but let's have a look at the chart from the Federal Reserve site, and then one that I have put together myself. But in simple terms, without going through an explanation of how the yield curve inversion works, if we look at this graph going back to the 80s, we can see that every time the interest rate on the 10-year US government bond was lower than the interest rate on the 3-month US government bond. So if long-term 10-year interest rates were lower than the short-term interest rate, that generally signaled that there was a problem in the economy, that a recession was about to hit, and it's been a very reliable indicator. We can see it predicted the recession in the early 80s. We saw a yield curve inversion in 1989, and there was a recession in September 1990. Before the dot-com bubble burst in 2000. Keep in mind, this is from the Federal Reserve's own data. This is their preferred measure of predicting recessions, predicting problems. You can see that when it crosses below this zero line, meaning that the 10-year interest rate is lower than the short-term 3-month interest rate, we can see that a recession, we had the dot-com bubble burst and the 2001 recession. And then, of course, before the global financial crisis, you can see in mid-2006, yield curve inverting. And then, of course, we had the global financial crisis, the worst recession in 100 years. Make of this what you will, but by August or by mid-2019, there was again another yield curve inversion. So the debt markets were screaming that there was a problem. And then, of course, we had the events of 2019, 2020. We had that massive recession, but note the gray area indicates recession. We had a very small recession during the COVID crisis, and that's because governments around the world have, quote, and I use this word loosely, they've learned how to print trillions of dollars, how to slash interest rates, how to artificially prop everything up. So it ended up being a very small recession technically, but as many of you are aware, if you've been listening to me for a few years, governments, central banks did so much damage during that COVID period. And have a look at the level of inversion that we're experiencing. But really, it started in late 2022. Not just the depth of the inversion compared to other previous crises, but the length of time that the yield curve has been inverted. So this is the debt market screaming at you that we are about to go through the worst economic kind of crisis, recession, depression, whatever you want to call it, in modern history. And we can see that it's not that the recession or crisis hits when the inversion occurs, it's when it recovers. Notice how once it recaptures the zero line, then in 6 to 12 months or so, or maybe a bit longer, maybe 18 months, then the problem happens. And we've just recaptured the zero line. And you can see on my chart over here in TradingView that over the last few weeks, we've recaptured that line. So that's the debt markets telling you that it's a lot closer, these problems. I would say that's part of why Jerome Powell's cutting rates, even though he's claiming everything's great. He's smart enough to understand what is going on here, what the debt markets are signaling, and that is going to be a big problem. And of course, one of the reasons they have to cut rates is because in the first 2 months of the United States financial year, The US budget deficit was 624 billion US dollars, or about 1,000 billion Australian dollars. So the US government was able to. Now, this isn't the amount of money that they borrowed. This is what they collected in taxes. They spent everything they collected in 2 months, and then spent an additional $624 billion in just a 2-month period. So government debt is going exponential. It's spending debt is on a path to infinity, basically. And we can see the total US debt went up $1 trillion in 105 days. So this data only goes till, I believe that's the end of November, early December. What day was that? December 4th. And, Zero Hedge is making the point correctly that, Trump and Elon and this Doge Commission, whatever you want to call them, they're an advisory board. They don't really have any power other than to the extent that Trump and the Republicans and the Congress and Senate listen to them. What, if anything, are they going to cut on net balance? So the US government is, accumulating debt at a pace of about $3 to $3.5 trillion per year. So even if they magically discovered a way to cut $2 trillion, which they won't, I'll cover that in another video, the debt is going to continue to grow. Now, why has the Federal Reserve effectively done 3 interest rate cuts when inflation is picking up? So this graph here shows the United States inflation rate. So this is the headline CPI. And I know a lot of us don't agree with these numbers. I don't. I think they understate inflation. But if we just take the government and the Federal Reserve at their numbers, the Federal Reserve, so this red line that I've drawn here is the 2% maximum allowable inflation rate. As per the Federal Reserve's target, they're supposed to keep inflation at 2% or preferably slightly below 2%. And you can see in early 2021, it spiked all the way up. It started its spike above 2%, got all the way up to 9.1%. So most of the world, including the United States, has had a 3-year period of inflation running way above the maximum allowable target. And you can see the low point was in September this year, 2.4%. Never once has inflation on the headline number gone below the maximum 2% allowable target. So again, why is he cutting interest rates? Why is he saying, the economy's apparently, if you believe the chairman, he says the economy is in a really good place, and he's feeling very good about the economy. So if you're feeling very good about the economy, why are you cutting interest rates? And secondly, with inflation having never fallen to your maximum target level, why are you cutting interest rates? Again, look, it's pretty much been going sideways for the past 18 months. I mean, that's June, July 2023, around the 3% level, and just kind of going sideways from there. And if we look at the core inflation rate, and this is zoomed in, showing 1 year of data. So the core rate excludes things like food and energy, that stuff that none of us buy. None of us buy food, none of us buy electricity or petrol or any of that sort of stuff. So, why count that? But even by this measure, the number is worse. The bottom in inflation was in July of 2024, 3.2%, so still way above their maximum 2% target. Then it was 3.2% in August, and now it's starting to flatten out and potentially pick back up again. And if we come across to the Federal Reserve's preferred measure, which is the core PCE, this is again another very doctored form of inflation where they play around with the stats quite a bit. But again, this is the Federal Reserve's measure that they prefer, and we can see again inflation bottomed at 2.63% in June of this year, still above their maximum 2% target. And what's it been doing since then? Looks like it's trending back up. So again, why are they cutting rates? And if you were holding out hopes that, I've stated before that while Trump might do some, him and his administration might do some cosmetic spending cuts to say, hey, yeah, look at us, we cut some stuff. I think overall, just the mathematics of the situation, that he'll grow debt, he'll grow spending. He's not a savior. He's not going to fix the economy. And we can see yesterday, President-elect Donald Trump gave an interview to NBC News on the phone, and he said that, sorry, let me highlight that so you can read it. This website's not so great. He said Thursday that Congress should get rid of the debt ceiling. So in a phone interview with NBC News, Trump said getting rid of the debt ceiling entirely would be, quote, the smartest thing that Congress could do. And he would support that entirely. So if you're going to cut spending, why would you need to eliminate the debt ceiling? I mean, you eliminate a debt ceiling because you want to accumulate massive debt. And of course, that's what he will be doing. You watch. Once he gets in, he'll continue to borrow money at $3, $4, $5 trillion a year. I suspect by the time he finishes his term in 2029, he will have added more debt than he'll break the record for most debt added by any president in a 4-year term. And so I hold very little hope that that they'll cut spending, that they'll stop accumulating debt. Now, just briefly on Australia, and I'll show you a couple of charts on Australia, and then we'll have a quick look at the major markets and cut it off there. But the Australian economy is now so a per capita means a per person recession. So it's seventh quarter. So almost 2 years now, Australia has been in a per person recession. So you were feeling a recession. Now, they've brought in 600,000 or so new people into the country, and so total GDP is growing. So the total economy is growing, but we've added so many people to it, and everyone's slice of the pie, your portion of the economy is shrinking. And this is the worst in Australia's history. So you could make a case that on a per person level, Australia is in the worst recession we've had, certainly in modern times. Australia's in a lot of trouble. We can see this is, how consumers are feeling, how, regular Australian consumers, how are they feeling? And of course, so the orange line is people who are owners of their house, so they don't have a mortgage to pay. They've paid off the house. They're feeling great. They're doing great because they don't have to pay rent and they don't have to pay massive interest on their super expensive real estate. They've paid off their house. So they're sitting back and they're benefiting from this real estate hyper bubble, from the prices going up. They're feeling good. Their houses, in some cases, houses in Sydney or in a few other parts of the country have generated, the average house has grown more in price than a person earns from their income, in average income on that year. So that is just ridiculous. But you can see owners and renters, mortgage holders, people paying interest on debt, and renters not feeling as good. That's not such a mind-blowing chart. But this one is our disposable income. We're going backwards, -8%. The rest of the world is growing. We're not doing so good. Our real gross household disposable income, so OECD nations, they're going up. Australia on the decline. We can see portion of income needed to meet mortgage payments. So this is the national median income, Okay, so it's very hard to get exact figures on this, but this is somewhat of an average or a median, the middle ground. And you can see Australians, going back to through the COVID period when mortgage rates were 2%, Australians were spending, roughly 30%, 20, maybe 29% at the low of their income to make their mortgage payment. Look where it is now, 50%. So there are a lot of households that are spending more than half their income to make their mortgage payments. So we have way too much debt. We have super expensive real estate. But inflation in Australia is still relatively high. It hasn't come down to target. Even the Reserve Bank of Australia has said they don't expect it to get there until 2026. And then Australian real wages, of course, are back to the December 2011 level. So we're going backwards. And then job creation in Australia, all that's happening is, and I'm oversimplifying it here, but state governments are going into massive debt to create a lot of jobs in the public sector, like healthcare, all these government jobs. So you can see public jobs being created. So state governments going into debt to create all these jobs. Look at us, the GDP is growing. Of course, they don't adjust GDP for the amount of debt that state governments are taking on. And the private sector is, by this particular measure, losing jobs. So our private economy is shrinking. Government, especially states, taking on massive debt to employ people. I mean, half the country will probably be working for the government soon. And the markets didn't like what happened with the Federal Reserve meeting. Yes, they did cut interest rates, but this just goes to show, and I'm going to switch back to some stock market charts. Let's look at the US market, the S&P 500. We're on a daily, a 1-year chart. But this just goes to show how markets are completely manipulated by what central banks are doing. How much money are they going to print? How much they're going to cut interest rates? So all that happened was Powell said, well, we were going to cut, or the market thought that they were going to cut interest rates 4 times in 2025, and he's saying now it looks more like 2 times. And of course, the markets they've had a massive rally, but they had a bit of a short-term panic. You can see that rising wedge that the S&P 500, the US market, was in, negative divergence all the way up. I mean, that was such a bearish pattern. We were so due for a bit of a sell-off. I mean, these stocks are just ridiculously expensive. But you can see it fell out of the falling wedge, tested the roof, and then spilled. That's, if you've watched my videos before, if you know about these patterns, this is pretty textbook. You break down from the pattern, you test the breakdown, or you test the breakout if it's a breakout. Same thing with the NASDAQ. It actually managed to pop out the top of a rising wedge, which is just goes to show just what a mania this is. And I think that might have been, I wouldn't be surprised if that was the final blow off top. Maybe we'll get another test of the high, but it's breaking down from these patterns. And if you look at take a look at a 5-year chart of the NASDAQ, it's, you can see negative divergence all the way up. It's just crazy expensive. In fact, maybe we'll delete those and see if we can find some sort of channel pattern there. I mean, it's sort of hard to read at the moment. It just looks very overpriced. One thing that did go up was the US dollar. We can see now, you may recall that a few months ago, back in August, I was talking about, coming US dollar strength. It was in a falling wedge, positive divergence, broke out, and then we had a flagging pattern, so a flagpole flagging pattern, which is bullish. Broke out of that, went for another run. You can see it breaks out, tests a breakout, goes for a run, another flag, a breakout. But now we're starting to see, after this big run, we're starting to see negative divergence on the momentum indicators. It has had 2 big runs now. This whole Trump hype, this Trump mania, I think is a little bit overdone. And the Aussie market, the Aussie stocks are looking even worse than US stocks. We can see Aussie market was in a rising wedge. That 8,500. If you go back to one of my videos from 12 to 18 months ago, and we look at the 5-year chart, I showed that the inverse head and shoulders of the Aussie market was looking like a breakout with the target of 8,500, and it got to exactly that point. Maybe we can have a quick look at it on the previous chart here. You can see this goes back to the 2021 high. You have the Aussie market trapped in this downtrend. So through 2021, you got the left shoulder, you've got the double bottom there, and with MACD divergence, with positive divergence on the momentum indicators, MACD and RSI. At that time, I was telling my clients to get out of any short positions they had, and that we should start getting more aggressively long in the market. That was a major lows. That was, get plenty of things wrong, but that was one thing I got right. And if you're a client of mine, or if you've seen my videos from back then, from 2 years ago, you would have recalled that I was hammering that point. There's the right shoulder there, and you can see the breakout. And generally, you measure, the breakout from the low to the high, and you can see that the breakout, well, maybe the target was 8,600. So I probably said 8,600, didn't quite get there, but it was fairly obvious that, in the short term, going back to the 1-year chart, the Aussie market was hitting an all-time record high. Rising wedge, which is bearish, negative divergence on the momentum indicators, bearish. When something's at an all-time high, you may recall from a couple of my previous videos, I talked about, my clients and I don't know if it's appropriate for you, please do your own research, but that we'd gotten out of a lot of our growth funds. We're in covered call funds. Some of us took some small short positions. And of course, the Aussie market had a spill out of the wedge. Note it had a couple of days where it tested the breakdown and then smashed. It didn't even hold these previous levels here. So we'll see how it does next week. Maybe we get, a little bit of a trading bounce, but I would be very concerned that we're going to just tread sideways for a few months or so, just grinding along. There's a lot of risk out there. So panic, bit of a panic, but just a short-term one. Like it seems like it's a big deal in the short term, but when you pull back, you can see if you look at markets, what they've done over 5 years, not as severe. So, but inflation picking back up. I don't know why that. Well, I do know why, but if you believe that the Federal Reserve is this transparent, honest, if they're serious about fighting inflation, why are they cutting interest rates when inflation has never fallen 1 month to even their maximum allowable target of 2%? So might cut it off there today. Hopefully that's some good info. A little bit less charting focus today and a little bit more bigger picture and what's going on in the news. Thank you so much for listening, and Merry Christmas. Cheers.